As individual investors and as managers, we would like to make investments that offered high rates of return with low risk. Unfortunately, if we want to get higher returns, we almost always have to take on additional risk. Consider the decision-making process and its effect on stock values. Assuming that economic conditions remain stable, any management action that would cause current and prospective stockholders to raise their dividend expectations should increase the firm's value. And the firm isn't restricted to returning cash to shareholders via dividends. It could also return cash to shareholders via share repurchases, which would reduce the number of shares outstanding and increase the value of each share. So that's another way that firms can give cash back to investors without paying dividends. Therefore, any management decisions that cause stockholders to raise their expectations about any cash inflows, whether that's dividends or share repurchases, should increase the firm's value. Therefore, any action of the manager that will increase the level of expected dividends without changing risk, in other words, our required return, those projects should be undertaken because it will positively affect owners' wealth. In other words, increase shareholder value. And decisions usually come with a risk-return trade-off. In other words, each decision is going to have a certain level of risk and return associated with it, and the combination of risk and return can increase or decrease a firm's share price. So for example, if management decides to undertake a project with low return but high risk, we could expect the firm's share price to fall. Alternatively, if management can find good projects to invest in that offer high rates of return at a risk level that's not too high, we would expect the firm's share price to increase. When we attempt to quantify risk or measure risk, it depends on if we're looking at risk of a single asset or if we're looking at the riskiness of a portfolio. We can think of most firms as portfolios of investments. For example, American Airlines has a portfolio of airplanes and terminals, baggage handling equipment, and so forth. Burlington Northern Santa Fe has a portfolio of locomotive, train tracks, and other infrastructure. So most of the time when we're looking at risk in a portfolio context. However, there are certain situations where we want to look at the riskiness of a single asset as well. So let's clarify some definitions about risk and return. So return is the total gain or loss experienced by an investment over some time period, and we calculate that by taking the cash that's generated by that investment. So that would be any cash distribution generated by that asset. So that could be for bonds, coupon interest payments for stocks, dividends. If we're looking at real estate, it could be rents. So any of the cash inflows or cash distributions during a period, plus any capital gains, changes in the value of the underlying asset, and we divide that by the beginning of period investment value. So risk is a measure of uncertainty surrounding that return, or a bit more formally, the variability of returns associated with an asset or investment. Again, we'd like to get a high return and take on very little risk, but in the real world, things don't really work out that way. Indeed, if an investment opportunity sounds too good to be true, in other words, if an investment opportunity appears to give high returns with very little risk, there's probably something going on there. Recognize this guy, Bernie Madoff. For many years, investors around the world clamored to invest with Bernard Madoff. He generated high returns year after year with seemingly very little risk. But then, in 2008, the Securities and Exchange Commission charged Madoff with securities fraud. His hedge fund turned out to be a giant Ponzi scheme. Investors were indignant, complaining that he had misled them. Well, he did mislead them. However, the investors have only themselves to blame because they bought this idea that you can find investments that offered high rates of return with very little risk. Investors should have known better. Bernie Madoff should have never been able to attract that many cash flows. But sometimes people get greedy and sometimes people get lazy and believe what they want to believe, even though common sense, if they just kind of stopped for a moment and said, okay, in the real world, how likely is it that somebody can really give me high rates of return with very little risk? By the way, Mr. Madoff was sentenced to 150 years in prison. You can see here he has a new job now. So again, going back to the definition of returns, to calculate the return on any asset, so this could be bond, it could be stock, it could be real estate, it could be anything, return is simply the cash inflows. So those cash inflows on bonds are coupon interest payments. For stocks, it could be dividends. For real estate, it could be rents, and so forth, plus the capital gains. And the capital gain is simply the difference between the ending period price and the beginning period price. And we scale that to get it in percentage terms by dividing it by the beginning period price. So let's do a couple of examples. So Robin wishes to determine the return on 2 stocks. At the beginning of the year, Apple stock traded for $411.23 per share, and Walmart was valued at $60.33 per share. During the year, Apple paid dividends of $5.30. Walmart shareholders received dividends of $1.59. At the end of the year, Apple stock was worth $532.17, and Walmart sold for $68.23. For Apple, the returns would be, let's see, the dividends for Apple was $5.30, and the capital gains for Apple was the end of period price was $532.17. The beginning period price was $411.23. So there in the brackets, that's the capital gains. We divide that all by the beginning value of $411.23. And that works out to be 0.307 or 30.7%. Then for Walmart, Walmart paid dividends of $1.59 per share, plus our capital gains for Walmart. At the end of the year, it sold for $68.23. Beginning of the year, it was $60.33. We divide all that by the beginning of the year value of $60.33, and that yields 0.1573 or 15.73%. So a quick concept check. You paid $10 for an asset and sold it for $15 3 years later. What was your 3-year dollar return? Well, you sold it for 15, purchased it for 10, so your 3-year dollar return was $5. Same set of numbers, you paid $10 for an asset and sold it for $15 3 years later. What was your 3-year percentage return on this investment? Well, our dollar return was 15 minus 10, and then to get it in percentage term, we simply divide by what we paid for it. So our 3-year percentage return was 50%. You paid $10 for an asset and sold it for $15 3 years later. Your average annual return on this investment is 50% divided by 3, 16.67%. True or false? False. The reason taking the 3-year return of 50% and divide it by 3 is wrong is that would be forgetting the time value of money and compounding. Recall, future value is equal to the present value multiplied by 1 plus the interest rate per period raised to n the number of periods. So if we algebraically kind of rearrange everything, our interest rate is equal to our future value divided by our present value, all that raised to 1 over n and then minus 1. And we do that for this particular problem, 15 divided by 10 raised to the 1/3 minus 1. That equals 0.1447 or 14.47%. So that demonstrates that there's a difference between the average return of an investment and the average return on an investment. And that the difference of those two is the difference in the geometric return and the arithmetic return. Suppose you have an investment in a stock that had a negative 50% return, so a loss in the first year, and a positive 50% return or a gain in the second year. Let's look at the arithmetic and geometric returns, and figure out which describes the performance of the stock returns and which describes the changes in the value of your investment. So let's take a look. So in the first year, we have a return of a negative 50%. In the second year, we have a return of a positive 50%. So if we started off at time 0 with $100, after the first year when our investment lost 50%, the value of our investment would fall from $100 to $50. And then in the second year, if it increased by 50%, so this investment increased by 50%, the value of our investment has increased from $50 to $75. So when we calculate the arithmetic average annual return, is simply going to be the negative 50% plus the positive 50% divided by 2. In other words, just a simple average. That works out to be 0%. So our average return of this investment is 0. But let's take a look at the geometric average return. So we'd calculate that as 1 plus the minus 0.5 multiplied by 1 plus the positive 0.5. And since this is 2 periods, we divide that by 1 over 2, subtract 1. And our average annual return on our investment was a negative 13.4%. So there's quite a bit of difference between the arithmetic return and the geometric return. So we can see here that the arithmetic average annual return captures the average performance of what we're investing in, whereas the geometric average return measures the average annual return on our investment. In other words, on the value of our original $100 investment. Now, the 2-year return on the investment, kind of tying this all together, let's say our 2-year return, our ending value is $75, subtract the beginning value, divided by the beginning value. So our 2-year return on the investment is a negative 25%, from $100 down to $75. Now, we could use our time value of money principles, right? Future value is equal to, we invested $100 multiplied by 1 plus the rate of return of a negative 13.4%. Got to put that in decimal form. Raised to 2 because it's 2 periods. That gives us the $75. And if we look at our 2-year return of a negative 25%, 1 plus the negative 0.25 raised to 1 over 2 because there's 2 periods minus 1 also gives us that negative 13.4%. So we're looking at averages. We need to ask ourselves which is more appropriate, the geometric return or the arithmetic return. If we want to see how a particular investment did, we look at the arithmetic return. If we want to look about how our investment in that asset performed, in other words, shareholder value, we want to look at the geometric average annual return.